down today as traders nervously await developments in U.S. talks aimed at reaching a deal to avoid a federal default. Trader and founder at Herenya Capital Advisors, Petri Redelinghuys, joins us now to take a look. Thank you very much for joining us, Petri. Let's start with a sense of how we're faring at midday trade.
Good afternoon, and thank you for having me. Midday, we are essentially flat. Top 40 index down 0.03%, so basically unchanged on the day. So far, though it is not necessarily a tale that is just that simple. Overall, most of the sort of strength in the market seems to be coming from some of the local stocks. So the banks doing relatively well, the retailers also doing relatively well, and this is, I guess, a bit of relief coming into them as they have been under tremendous pressure of late. And then some pain, of course, coming from some of the resource counters, so the likes of Anglo American Platinum, Glencore, Anglos, Sibanye, all under a little bit of pressure. At least that's within the top 40 index level. So, as you mentioned, I think the market is kind of just going sideways, a bit of relief coming into the locals. But that, I guess, uncertainty around what the future holds still weighing quite heavily on markets. Our market has been going sideways now since about the 24th of April, so about a month that we've kind of just grinded sideways. Our expectation largely has been for the market to weaken, which it hasn't done, and we kind of changed our tuning over the weekend as it looks as though U.S. markets at least are preparing to put in a bit of a rally in the sort of next week or so. So there are some things changing locally as well, which might have an impact. For example, there is an index rebalancing happening. At least the closing prices today will determine the exact sort of float changes within the top 40 index and various other indices. And we expect to see, one of the things that I think will happen in this index reweighting is that Richmond gets down-weighted quite significantly in the index, and we know that Richmond currently makes up around 17% of the top 40 index. So a lot of the strength that our market has had has been on the back of, really robust luxury goods sales, if you want to oversimplify, I suppose, and as well as a much weaker rand. So that influence drops away relatively soon. So I think we might see a little bit of weakness coming into the market after that, as we don't have that very strong Richmond to keep the market up, and we're more, I guess, subject to the moves of the more locally focused businesses. Look, it still obviously stays in the index and has a relatively big weighting, just that its influences will be significantly less. So for now, a relatively stable-ish kind of day. The rand actually stronger by about 0.75%, trading at 19.28 to the US dollar, so that's fantastic. Oil price down around 1/3% as well, $75.56. Gold price slightly higher at 19.79. But not really making a big dash. So I guess we wait for the U.S. session to open this afternoon. And as you mentioned, a lot of talk around, the debt ceiling and all that kind of stuff. We'll see how that plays out.
Okay, let's take a look at oil prices. They've slipped today. The resumption of ceiling talks today are expected to remain a key driver for crude and risk sentiment this week. Meaning what?
Right. So there's a couple of things. I think some of the influence here is the U.S. debt ceiling talk, right, as you mentioned. So, I mean, I'll give my personal opinion here. It's not the first time we've seen this, right? I've been involved in stock markets now for over a decade. Time flies, eh? But every now and then the U.S. runs into their debt ceiling, and they have this, oh, woe is me, what are we going to do? We don't have enough, credit essentially to pay all our bills. What shall we do? Oh, let's raise the debt ceiling and print more money. That's what they do every time. It's what they're going to do this time. This whole, the U.S. government is going to shut down because they can't afford to pay salaries unless they pass a bill through, the House to raise the debt ceiling. And if they don't, the entire government stops. The entire government isn't going to stop. They're going to make a last-minute deal like they always do, and the world will carry on. And it'll probably be just another excuse for people to buy the market, right? So I think that it's a bit of a storm in a teacup, to tell you the truth. The oil pressure at the moment, it's bounced back a little bit. So it's up around, it's up a little from the lows, but it's down around 1/3% at the moment. I think that's more... There's always opposing forces in the market, right? So on the one side, you have essentially just bullishness and what I think is probably going to be a short squeeze over the next couple of days or weeks. But there is still the overall structural issue where if you look at credit conditions in the U.S. economy, for example, it is worse now than it was pre the 2008-2009 global financial crisis. So feels a little bit like the market is barreling head on into a recession, right? And the Fed doesn't seem to care. They're going to continue to raise interest rates. They're going to continue to do what they need to do in order to contain inflation, which is exactly their mandate, right? That recession fear that I think the shorter term players in the market tend to ignore because we're here to follow and not predict, right? And the market wants to go up, we'll go up with it. But the longer term mindset is one of, well, there is this major structural problem that is not going away and is worse now than it has been sort of at any point in future. And if we see credit conditions decline, economic conditions follow. It's always happened that way and will likely continue to happen that way. So the market continues to trade very strong, particularly if you look at what tech has been doing in the US and around the world over the last couple of weeks. If, let's say, last couple of months, 5 months into this year, tech has been really, really strong. And that's kind of been in the face of what is worsening economic conditions with no sight of it ending anytime soon. And that disconnect, I think, is what we're seeing essentially as a driver of the gold price. We're seeing it as a driver of the oil price, because if we have a large-scale, or let's say medium-scale global recession in the second half of this year, that's obviously going to have a negative impact on demand for oil and for energy in general. So yeah, that's kind of what I think is happening at the moment. I mean, don't quote me on this stuff. It changes very quickly. For now, at least, that's the understanding that I have of what is kind of putting a pin on or putting some pressure on the oil price. And we're just watching it trade between a range of about $70.50 to $87.36. Give or take a little on those numbers, but that's basically a relatively large sort of $17 range that it's been in. And unless there is a break either above that range or out from beneath that range, I think it kind of just keeps drifting and going sideways until we have a bit of clarity and a bit of global, economic growth again. I think underneath 70.50, kiss goodbye to your oil stocks. I think they might get hurt relatively badly, but if that level doesn't break, then you're probably still mostly safe to hang on to them for the next couple of years.
So Netcare has published its interim results for the 6 months ended 31 March 2023. What do the numbers look like?
So Netcare's numbers actually don't look too bad. What's interesting here is, I just want to pull them up actually before I monologue here for days. So what's interesting here to me is that obviously there's a bit of a recovery. So the post-COVID recovery is happening. EBITDA up 24%, adjusted headline earnings per share up 31.5%, interim dividend of 30 cents. So, life is good, I guess. From a revenue perspective, they made 12% more revenue. From a profit perspective, they made 32% more profit. I mean, that's really a good result, really. And they cite that part of that, positivity in their results is that you have this return to normality post-COVID, which is good news. Also, what they've done, I think, that puts them a little bit ahead of the game. They spent the last decade essentially investing in renewable energy, right? Or not renewable energy, but energy independence, if you will. So just to look at some of these things, I think that they have fleet of, 72 sites capable of generating between 18 and 20 gigawatt hours per annum, right? And they've got something like 290 diesel generators, 200 backup diesel generators to support their facilities across their sites. And, they're expected to spend about approximately 165 million rand per year on diesel, which is a lot of money. But they have the solar energy that they need. They have the diesel energy, generation capacity that they need, and they can eventually run as little islands, completely independent of Eskom, and that is a major advantage to them. So it's, I guess, you look at now and you say, well, they started this project 10 years ago, and the payoff is today. So it was a very good move, I think, from Netcare and from their management. So hats off to you, sirs and ma'ams. It's really sort of paying off. I mean, their income kind of sitting at 618 million rand versus what the market expected at 415 million. So really blowing the expectations out the water. So a solid result. And one that seems sustainable. Look, the fuel bill will probably only go up, but they do have an enormous amount of solar energy as well that they have, at their disposal, and they're kind of energy independent. So, good on them, and I think that hopefully they set a good example for other companies to do the same.
So you've got happy shareholders there. What about Baldwin Properties? They also released results for the year ended 28 February.
So Baldwin also set up a fairly decent set of results, if I'm not mistaken. Let me just quickly have a look here. So they also had most of the things sort of increase. What revenue is up 6%, although what's interesting is that deliveries of homes, or sales, if you will, was down by 6%. So there is a bit of a higher margin phenomena happening there, which is quite interesting because their gross margin is something like 29% now. I think it's up to 29% from 27% last year, which is really good for a construction business, I think. I mean, 30% profit on everything that you build isn't too bad. So even though the number of apartments that they've delivered has reduced, their overall profit is up. And this is in spite of, all the load shedding, all the input material going up as well. And what I've noticed that they do as well is that a lot of the newer developments that are coming out are sort of off-grid ready, if you will. Comes with solar, comes with batteries. So when you buy a newly built apartment from them, you already have, most of your energy independence kind of resolved, which I think is a brilliant strategy and is one that hopefully more construction businesses will lean into and, will alleviate our economic situation in South Africa somewhat.
Thank you very much, Petri Redelinghuys, founder and trader at Herenya Capitals.